The Canadian Business Ethics Research Network is funded by the Social Science and Humanities Research Council. It's a rather unique kind of program. It's one of the very few in the country that has been funded. We have a $2.1 million grant coming thanks to the Canadian taxpayer through the Social Science and Humanities Research Council competitive system. And the purpose is to identify the importance of business ethics in the corporate community and in the economy, to bring researchers from across the country together to think about the importance of ethics and to understand, to explore how best to move research ideas into the business community. But CBURN also has a very unique approach because the network is based on the observation, and I think the reality, that if we're going to work effectively in areas like business ethics, we have to have communication moving in many different directions, from business back into the academy, from the NGO sector across to business and back into the academy, and between and amongst government, the NGO sector, business, and academics who are doing research. It also involves the recognition that an awful lot of research is going on in those other sectors. The NGO community is actively involved in research into ethical issues. Government is actively involved into research into corporate ethics issues in a variety of different ways, and so too is business and the academy. So we have a very unique role, which is to try to create dialogue across sectors in ways that both highlight the importance of the field, business ethics, but also which highlight the importance of dialogue if the kinds of problems that we are facing today in various economic sectors, the Canadian business community, but much more broadly, are going to be successfully addressed. And I think I might be permitted to say that there can't be a period of time in economic history where ethics is more important. Reflection on the ethical responsibilities of corporate leaders, as well as other leaders who are intersecting with the corporate sector, setting regulatory standards, for example, establishing guidelines. There can't be a time in economic history where that kind of dialogue and serious thought about the role of ethics in business has been more important than it currently is. It's a new step for, we've had annual meetings on a regular basis, but this is the first time where we have stepped out of our own conference environment to invite members of the local community to participate in the dialogue, and we certainly want to welcome you to that. We also want to introduce you to the work of the Canadian Business Ethics Research Network, and to know that there are really enormous resources across Canada and also here in the Maritimes and in the Atlantic provinces in that particular area. And this is certainly one of our objectives. What we have done today is to invite Ed Waitzer to introduce a discussion on corporate governance. Our theme for this conference is corporate citizenship, corporate governance, and leadership, and that's what we're looking at for the whole of the day. This is an important component of that particular discussion, and Ed, in many respects, incorporates in his person what CBURN is all about, because Ed Waitzer is first of all a lawyer and therefore a professional by training, and a member of a prominent Canadian legal firm. He also has participated directly in the business community on the Ontario Securities Board and has direct experience therefore with the regulation of business and with the encouragement, stimulation of business environments. And most recently, he's moved into the academy and is now a member of the faculty of York University with a very interesting mandate, which is to create bridges between the study of management and the study of law. And in my view, and Ed will perhaps comment on this, but I think recognizes that the study of management and law together can't be undertaken in a creative or innovative or even a practical way unless we understand what the ethical responsibilities of managers and lawyers are, and the role of law in setting standards, the role of ethics in understanding what those standards ought to be. So it's a great privilege, and I'm delighted to be able to introduce Ed, who's going to lead us through a discussion then of corporate governance and the challenges that are posed for it in today's economy. Ed?
Thank you, Wes. Wes, as a colleague, is one of the people who has forced me to ask questions. So when he asked me to come out here, it was hard to say no. And what I propose to do today is try to engage with you in the same exercise, asking some questions about corporate governance. Firstly, let me thank both of the sponsoring organizations, and particularly thank those of you from the local community who took time out of your day to, including the minister, to engage in this discussion with us. Before I start framing some questions, let me try to frame the challenge. And I'm going to speak about corporate governance, but I know many of you in the room are involved in the governance of other kinds of organizations, and hopefully some of what I'm going to describe will resonate with you as well. But when you think about the role of corporate boards, most people would say their job is to oversee strategy, oversee succession, take a longer-term view, and be supportive to management in thinking about the longer-term role and sustainability of the enterprise. And in doing that, you have to set up, hopefully, a constructive tension, but a tension that ensures that insiders, those who are spending all of their time, day in, day out, actually managing the organization, don't take advantage of information asymmetries to advance their own agenda over the agenda of the enterprise as a whole. And we can have a debate about what the enterprise as a whole means, and whether we're talking about shareholders or other stakeholders. But for at this point in my discussion, we don't need to go there. I'll get there in a little while. And I think the reality is that no matter how dedicated and how competent directors may be, it's unlikely that most can achieve what is expected of them. And ironically, the focus of regulation of late on independence probably net puts them at a disadvantage. And I'll come to that. I'll also come to the fact that reliance on outside professionals, which is encouraged increasingly by our regulatory frameworks, probably isn't the answer. So we've got challenges with capabilities. There are underlying issues around incentives, and we've got the fact that it tends to be management still that choose directors, and that leads to selection bias. So you have organizations where performance is most needed are the organizations where you're least likely to get good directors. Conversely, organizations where you probably, I'll give you an example. Well, actually, I won't give you an example because it'll be too close to home. I can think of many corporate boards where the CEO really doesn't need a board, and those tend to be the ones where you get really good boards. So you have that sort of inversion. Why do people go on boards? Often it's because of personal relationships. For some, the compensation is attractive. For many, it's a social thing, it's a status thing. For some, it's about personal growth. None of those kinds of motivations make it likely in and of itself that individual directors are going to effectively challenge and support management, and for that matter, their fellow directors. So that becomes the issue. You look around at people who are sort of challenging assumptions about governance, and the most recent is Roger Martin, who's dean at the other business school in Toronto. And some of you may have read about, there was a review of his book in the Globe and Mail yesterday. What does he say? Well, he says the answer is we have to rethink what governance is all about and look for public service motivated directors, and almost think of directors and the selection of directors like we think about judges. They do it because it's a higher calling and out of a motivation of public service. Well, the other thing he says in his new book is basically stock-based compensation is a bad thing, full stop. I can't say I agree with either of those. I think we, the notion that we are going to convert board service into some public service, we may get there at some point, as the notion and Dirk's discussion this morning about sort of the publicness of corporations. And publicness is no longer defined by securities legislation. It's really defined by the role of corporations in society and expectations of it. So we may get there, but today I think there's still fundamental cultural differences between private enterprise and public service, whether we're talking about government, military, church. It's sort of the discussion that Jane Jacobs raised in her book, Systems of Survival. And trying to mix those two up without thinking it through carefully is likely to lead to some perverse results. Likewise, saying that stock-based compensation is bad, period, just doesn't make sense to me. I agree with Roger that we need to broaden out timeframes and align incentives to a longer term. What I like about Roger, and this is his kind of management consulting background coming in, is he frames provocative questions, and I think that's exactly what's required today. Why? Because we have a corporate governance structure and regulatory framework around it that has given rise to unrealistic expectations. We have myths about accountability, myths about perfectibility of decision-making within the corporate framework. Gives rise to all kinds of unintended consequences. The more rules we pile on, the more we encourage those who are charged with responsibility for governance to seek refuge in the process and the details, and that in and of itself becomes a moral hazard. You lose sight of kind of what the purpose is. In a perverse way, the burden of regulation leads to a diminution of responsibility. What do? We delegate it all away, and corporate law provides certain defenses when you rely on the advice of professionals, so we can delegate away, in effect, the liability and the responsibility, and in the process spawn a cottage industry of lawyers and compensation consultants and pension consultants and governance consultants, but we're dumbing down the process, and we're creating an environment for directors which is almost conducive to a siege mentality. They're not sure what they're supposed to be doing. They're under constant attack. So what do? You hunker in, you close ranks, which is the exact opposite of what leadership and governance should be about, which is engaging proactively with your various stakeholders. Cumulatively, what we see is this inverse relationship between huge resource investment in trying to get to better governance through regulation and compliance and public trust. So if the purpose of good governance is to increase trust in our institutions, we've got this investment and this piling on of regulation which seems to lead to a constant diminution in the level of trust in those institutions. And this goes beyond the corporate sector, incidentally. And all of that leads inevitably to a cumulative sense of fatigue. But even as we are fatigued and as we kind of hunker down and as we sort of find defenses in process over purpose, we keep doing more of the same thing. We keep layering on more legislation, more expectations, without kind of thinking about what it does to corporate cultures, what it does to leadership, what it does to the things that really matter in making organizations work, attracting the right people, motivating them. So having framed that as the problem, better keep track of the time. Let me now sort of ask some of the questions that might be worth asking, and I'm going to start sort of on pretty thick ice, and I'll probably, depending on how much time we've got, wander out onto some pretty thin ice, at least in terms of my own thinking, and hopefully one of you will kind of pull me out of the cold water if that's where I end up. But an easy one is just board composition and selection size. We know from a wealth of literature in the psychology field that groups much bigger than 8 diminish in terms of decision-making effectiveness. So 8 seems to be about the optimal size. If you look around at most public boards, and they're getting better, they're getting smaller, but most public boards are significantly larger than that. So that in itself tells you we've got things wrong. I've got Tessa in my sights, and her mentor, who's a great thinker in this area, who happens to be a geographer, has done work on sort of board selections, Gordon Clark at Oxford. So in some of his recent research, for instance, he's found that 50-year-olds don't outperform Oxford undergrads in terms of effective governance. So we have some myths about kind of what kind of competencies. On the other hand, he's found that specific expertise makes a difference. So we know that size matters. We know that expertise matters. We know that leadership matters a lot. But leadership is hard to prescribe because leadership is very context specific to the nature of a particular board, its ownership structure, its management team. So it's very hard to be prescriptive about who will make a good chair, who will make a good director. Independence of mind matters, but independence as a regulatory construct, and I'll come back to this several times, I think net has diminished the quality of corporate governance. And what it's done in many situations is really restored the imperial power of the CEO. Because if you have a bunch of independent directors who aren't spending a lot of time, who suffer from information asymmetry, they ultimately become captive to the CEO or the chair. Let's kind of go a little bit further out and talk a bit about board time commitment, resources, decision dynamics, and it's interesting if you look at proxy circulars. One of the things that's striking is how little corporations describe their decision making in terms of taking a broader, longer term view. So I went through this exercise recently, and I'm not purporting that these numbers are precise, but in the order of less than 20% of the proxy circulars I looked at identified performance periods of greater than 3 years. And this is for purposes of executive compensation, which is probably a good benchmark. Very little in any of the proxy circulars, actually, I should say very little in most of the proxy circulars about compensation for creating future value, things like innovation, taking risks, and not surprisingly, very little in the way of non-financial metrics. Well, that tells you volumes either about the level at which a corporation is prepared to describe what it's doing, or worse yet, about what it's actually doing in terms of decision-making processes. Why do we assume that working longer hours, which is what we've imposed on directors because of essentially compliance burdens, is going to enhance their effectiveness? Are there other frameworks or practices that might achieve that result? And here again, Gordon has done some interesting work. It's curious that sort of a geography scholar comes to all of this, but he comes to it partly because he's been involved in the governance of several pension plans. But he's identified some of the causes of poor collective decision-making: a lack of focus, no prior agreement on the purpose of whatever the deliberations of the board are going to be. The nature and scope of decision-making often overwhelms the process of collective deliberation. The presence, which any of you who spend much time in most boardrooms will know, of unacknowledged and unresolved conflicts, get in the way of finding common agreement. I mentioned the fact that delegating has become problematic, so let me spend a minute or two about that. The need for independence as a regulatory construct and the formalization of governance has tended to spawn a demand for metrics and assurance providers, if for no other reason than to mitigate liability. So directors have a duty to act in the best interests of the corporation, and directors have a defense in most cases in exercising their duty of care and duty of loyalty if they rely on expert advice. Interestingly enough, those to whom they delegate effectively don't have the same duties. So we break the chain of fiduciary obligation, if you will, by delegation, and therefore, not surprisingly, and this is true not just in the corporate sector, but it's true in the pension fund sector, the institutional investor sector, not surprisingly, you have this increasingly lengthy chain of delegation. And it's a chain in many ways, particularly in the financial services sector, where, that's upside down, where agents are almost always doing better than principals. So not only are the duties not there, but in fact the duties get inverted. Agents are acting in the best, or delegatees are acting in the best interest of themselves. There are a bunch of other problems with that chain of delegation, information asymmetries, the difficulties in assessing the competence of those to whom you're looking to for advice. I've spent a lot of time in boardrooms with compensation consultants, and some of them are very thoughtful, and some of them are awful. And some of them are horrifying. I sat, and I'll give you an example from a couple of months ago. I sat in and this is more a story about how regulation leads to bad results. Under Dodd-Frank, one of the proposals is a requirement that corporations will have to disclose, in effect, the spread between the most highly paid and lowest paid people within the organization. So I sat in a board meeting last fall where a compensation consultant came in, and they were tasked this by management, but basically had been tasked to develop a strategy for this organization of, and this was a large American corporation, but where they were going to outsource the lowest paid jobs in the organization in order to narrow that spread when it came time to have to disclose, or in anticipation of this new disclosure requirement. Well, think about that. So you've got Congress mandating disclosure, which will have the effect of exporting jobs out of the United States. And that will be the net effect of that requirement adopted in the names of improving corporate governance. And you've got professional advisors who we'll jump through that hoop. Some of the other difficulties with sort of reducing things to metrics, and again, actually, Roger talks about this in his book because he likens corporate performance, he contrasts it to NFL football, which is one of the great success stories. And basically, the contrast, he says, is look at in football, compared to, for instance, baseball, where baseball, there have been 2 rule changes in the last 100 years in baseball. NFL, every year they sit down and they tweak the rules. Why? Because any metrics you come up with run down over time because people are going to learn how to play to those metrics and game the metrics. And so he argues that it's not surprising that, baseball as a franchise has diminished in value. Television rights for baseball, I think, I forget what the number is, but it's under $1 billion. Television rights for NFL football are now multiples of billions, and that's an inversion over the last 20 years. And it has to do with good governance, focusing on real performance and being prepared to adjust your metrics, knowing that one size doesn't fit all, and any metrics you come up with will run down over time. Delegation clearly leads to a focus on process rather than purpose. And again, if you're a board that has a limited amount of time and your agenda is filled with compliance issues, it becomes very hard to see the forest from the trees. So a bunch of challenges we face around delegation. Face a bunch of challenges around risk management and oversight as well. And again, starting with the notion of auditability, risk governance isn't something that can be reduced to, I read these books about governance, or they're kind of like all business books. They're kind of like air sandwiches. They start well and they end well, and there's nothing in the middle. And it actually, many years ago, very early in my career, I wrote speeches for Robert Stanfield, who was a great man. But the secret to writing speeches for him, and in those days, he used to write the speeches out on index cards. So we would have a couple of good index cards at the beginning and a couple of good index cards at the end, and it really didn't matter what you put in the middle because he was going to go off and talk about whatever he wanted to talk about, and there'd be somebody sitting at the back of the room who would kind of wave when it was time, and he would go to, and you tab the sort of back half of the index cards, he'd go to those, so he started well and he closed well, and it was sort of a mug's game where he went in the middle. Well, that's a little bit where we are. Until we think about what kind of skills and incentives are needed to go deeper in exploring risks, recognizing how tightly interconnected everything is in today's environment, and what we can do to help directors challenge the boundaries within and beyond the enterprise, rather than seeking to preserve them. Let me spend 2 minutes on the role and responsibility of shareholders. And I guess my question here, again in the spirit of framing questions, would be how much direct democracy makes sense in the private enterprise context? We seem to be on this trend of importing notions of political democracy into the corporate world. It isn't at all clear to me that shareholder voting necessarily correlates to meaningful accountability. It certainly isn't clear to me that we should be transferring power to shareholders, which is what we're doing now, without at least thinking about the extent to which, in assuming new powers, they should also be assuming responsibility and accountability. And when you get to that question, people kind of come to a hard stop, because the traditional construct of corporate law is limited liability, right? You are the owner. You're not the owner of the corporation. You're the owner of a share. But sort of the genius of corporate law was this ability to own this fungible, tradable item where you had no liability beyond whatever you paid for that share. And so when we say, well, if shareholders are going to have a bigger role in decision-making, have additional powers beyond the traditional kinds of remedies in corporate law, should we also be imposing accountability and responsibilities? Maybe, we should be saying, shareholders who A, have stuck around for a while, and B, have a significant stake, should have more of a say, for instance, in selecting directors. But if we're going to let them have more of a say in selecting directors, we should at minimum be imposing on them the same duties in the exercise of that power as directors have. That is, in their selection of directors, they should be subject to a duty of care and a duty of loyalty to act in the best interests of the corporation. Why would we give them power without expecting that of them? And that's a discussion we just haven't had. I'll raise two more sets of questions, and now I'm getting closer to the issues that this group has been discussing. Let's spend a minute or two on corporate citizenship. We need to do a lot more thinking about, and I suggested in my introduction, the whole notion of, as I was sitting listening to Dirk's discussion this morning, I was thinking about the whole notion of a public corporation, which is a definition that was imposed by securities laws, in effect as the threshold for accessing capital markets. Well, securities laws have largely been transcended by technology and globalization, and our notion of what a public corporation is has been similarly transcended. And being a public corporation today relates to a much broader set of expectations, and how those expectations are addressed by boards is becoming challenging. Think for instance of think of Vedanta, a UK-based mining company that decided to develop a mine in India. It was developing a mine on a site that had historic religious significance for a local group. It went through the process of getting site clearance approval, including clearance by the Supreme Court of India, and a non-governmental organization in the UK brought a complaint under the OECD guidelines for multinational corporations. The complaint was dismissed through the domestic complaint handling process. I'm not sure I have the right words. That decision was appealed to the UK courts, and the UK court issued an injunction enjoining Vedanta from developing the mine, and the stock price of Vedanta went down by 50% in a day. So you have a UK company carrying on business in India in accordance with in compliance with all Indian laws, and enjoined by someone who they probably didn't think of as even being a stakeholder, an NGO in the UK, bringing a complaint ultimately before a UK court over their conduct of business in India. Those are the kinds of issues that boards are increasingly having to wrestle with. Do we need to start thinking about other kinds of frameworks for citizenship? Walmart's approach to supply chain management, where they really look at their suppliers almost from a portfolio perspective. They've got this portfolio of suppliers, and they want to ensure the quality of those suppliers and the compliance of those suppliers with social standards. Why? Well, because when something goes wrong in one of those suppliers, I think about the toys with lead paint. What happens instantly? Who's held to account? It's not the plant owner in some town in China that's held to account. It's Walmart or Costco or whoever the end retailer is, and it goes right to the top, and it goes and that accountability is immediate and absolute. Again, should we be thinking more in terms of duties to consult, the kind of thing that we've learned a lot about in Canada over the last several decades in dealing with our First Nations, which brings me to perhaps to the last set of questions that I'll leave you with before hopefully we engage in a discussion, which is thinking about reporting processes. And this is really a comment on leadership in a connected age. I was reading, actually, on the plane out here, something about General, I'm not sure I can even pronounce his name right, Petraeus, David Petraeus, the U.S., and the fact that in a highly militaristic structure, which tends to be command and control, if you send him an email, you'll hear back from him within an hour, and you meaning anybody. And what's the message there? The message there is that the commander-in-chief is open to feedback and conversation and sees it as a way of staying informed and connected. Well, that's kind of a different management style, and it's a completely different construct than, for instance, how we think of reporting process in public corporations today, which is modular, right? It's you build it up within the organization in order to comply with regulatory requirements, and then post Sarbanes-Oxley, it's certified 7 ways to Sunday, but it is then delivered out to whatever the audience is. Perhaps we need to think about reporting more as a process than as a product, as a form of engagement with these various sets of stakeholders, and in that context also think about how we can take advantage of technology to facilitate that kind of integrated, continuous, two-way engagement, so that those with governance responsibilities, like General Petraeus, can stay informed and connected with their stakeholders, and that in turn can inform them as well as informing the stakeholders about the role and importance of the enterprise. Ultimately, all of this is about people and culture. Structure doesn't get you very far, and sort of the difficulty is when things go wrong, there's a demand for the appearance of solving problems, and that demand usually leads to structural kinds of answers. A lot of it has to do with the need to realign incentives. A lot of it has to do with the need to take a longer, broader, more systemic view. But the starting point is, I hope, asking the sorts of questions that I've thrown out, and there are lots more, and I'd be delighted to engage in that discussion with you now or at any time. Thank you.
Well, thank you very much, Ed, and we do have time we have about 15-20 minutes for a question period. So the question is about what Ed meant with his comment about stock-based compensation not necessarily being the way to go, and what is the context of that? You'd like him to elaborate on that?
Please.
Okay.
So let me give you Roger's argument to start with, because it's not a bad one, and again, he analogizes to football, but his argument is that actually, let me back up. When you look at the history of compensation, and one of the first things I was supposed to do when I became chair of the Ontario Securities Commission was impose, by my minister said, I want you to impose disclosure requirements for executive compensation, to which my response was, you know what, that's really your decision, not my decision. It's a legitimate political decision. You should be aware that it will inevitably lead to 2 outcomes. One is compensation will ratchet up. Why? Because no board wants to think that they have a 3rd quartile CEO. That leads to a lot of discomfort. That kind of puts them in a situation where they've got to deal with problems that they'd rather not deal with. The second consequence is it will only be a matter of time until the same degree of transparency is demanded in the public sector. And both of those things happened. Every attempt to regulate compensation over the last 30 years has had perverse, adverse, unintended consequences. When the Clinton administration put in restrictions on salary compensation, which led to, which was basically anything over $1 million wasn't tax deductible to the corporation, that led to the explosion of stock options, which was sort of, heads, management wins, and tails, we reset the options so management have another chance of winning. It's just, we haven't got it right. Roger's argument is that sort of compensation regulation has led to this split between in what we manage, and CEOs are basically told by the incentives that they are given to manage expectations instead of managing real performance. And that's led to a bunch of things like increasingly short CEO tenure, an explosion of M&A, where, through a bunch of devices you can basically reset the bar and take the upside and then move on to another job. But that's his argument. I'm oversimplifying it. And he says, and he contrasts that to football where, good quarterbacks don't get paid based on sort of what the point spread is made by the bookies before a football game. Good quarterbacks get paid for performing on the field and get paid for leadership and a whole bunch of other things. So he's saying somehow we've got to get back to that. And he then goes on to say, and any stock-based compensation is the wrong way to go. I depart with him at that point because, and he doesn't argue against employees owning stock. He just says that shouldn't be part of the compensation package. I just don't, I think that's overly dogmatic. I think the issue isn't what currency you use. The issue is what kind of incentives you create, what kind of time frames, what sort of things you're looking to in determining compensation, and the currency is only relevant to the extent that it creates perverse incentives. So that would be why I pause at his conclusion, but I agree with sort of his diagnosis of the problem.
I was interested in what could be a competition between your premise that board success is predicated in some degree on expertise against board size. Okay, so although I believe in the 8 number, would expertise then be looked at from a diverse skill point of view? If you're reducing the number to 8, if you want expertise as part of board success, what is that expertise and what range should it cover?
Well, it's interesting, and you see these matrices that governance committees come up with to achieve diversity, and there's subject-specific expertise, there's leadership expertise or interpersonal expertise. Some of the best directors I know, and I've sit in on a lot of boards or have been involved in a lot of board decision-making, may not know very much about a subject, but know how to ask questions in a way that causes people to think and doesn't put people on the defense. And it's that ability to provoke thought processes that ultimately leads to better outcomes. So but so much of it, the kind of people you need, or the mix of people you need on the board of a controlled corporation, maybe with a dominant controlling shareholder, may be very different from one of a controlled corporation with a not so dominant controlling shareholder, and different again from a widely held corporation. So, and there you look at sort of the personality of the CEO. The example that I was going to give that I paused myself, I acted for BCE when it went through what turned out to be an aborted change of control process, and we got to go to the Supreme Court of Canada. But you look at the governance, and that was a blue chip board. I would argue a relatively ineffective board at the time, but from a process point of view, you couldn't have gotten a bit better board. It was way too big, way too much attempt to sort of have all regions, for good reasons, but represented in every, you look at the board today, which ironically is sort of a hybrid of where it was going to. It was going to go to a private equity board. Private equity boards are very small. Nobody's independent. They've all got a huge amount of skin in the game and a huge stake. Their incentives are very aligned. It's, how do we maximize resale value 7 years out, 5 to 7 years out. BCE now has a hybrid between sort of the traditional public company board and a private equity board, including a couple of private equity folks on the board, even though the private equity players ended up not being successful in acquiring the company, and there's still a lawsuit for a very significant break fee outstanding against the private equity players. And I would argue that George Cope could run BCE without a board. He's the kind of CEO that doesn't need a board. He uses his board well, but doesn't need a board, whereas Michael, who had many talents, kind of a board was very helpful for him because kind of someone to impose some discipline and just, so it's very hard to be prescriptive. And I'm not answering your question, but I'm hopefully illustrating some of the challenges. Tessa? Oh, sorry.
Somebody at the back.
You're next.
Tessa Head, Carleton University. Not surprising for me from some of my research on the role of responsible investors in these questions about good corporate citizens. But I wanted to dig a little bit deeper into your comments toward the end of your presentation about some of the dangers, if you will, of shareholders nominating independent board members to boards. Because it seems to me that every time we have one of these major crises, as we've just had with the financial crisis, or even with Enron, and these are things that are in the public record, that the investors, many of whom are large institutional investors these days, are then asked, in what way did you hold these firms to account? Where you have this major ownership of the firm. And if it's not through nominating independent board members, then what is the mechanism by which these big institutional investors could hold these companies to account? And then my follow-on question, which came directly out of your remarks about duty of loyalty and duty of care, is that if the shareholders are nominating, then ultimately the director that comes to the board is under the duty of loyalty and the duty of care, and therefore, does that by extension mean that the shareholders must also be, or that just their nominee takes that responsibility when they get to the board?
So let me give you a three-part answer to a two-part question. The first part which you didn't ask is people who live in glass houses should answer the doorbell. So you've got these institutional investors who are busy demanding more and more accountability and more participation in corporate governance process, and at some point, sooner rather than later, they're going to need to spend more attention to their own governance processes, and in fact, their governance processes are a lot more challenging. If you're a corporate director, you may have to sort of scratch your head about what the best interest of the corporation means today. If you're a pension fund, but you'll probably figure it out. That's part of the dance of what we do, and that's why directors are there to mediate different interests. If you're a pension fund trustee, you don't have that intermediate. Your obligation is directly to beneficiaries, and your obligation isn't just to current beneficiaries, it's to future beneficiaries. So, and there are things in trust law like the duty of impartiality, so you've got to scratch your head and think about, how do I achieve intergenerational equity? Those are really tough problems, and not a lot of thinking going on there, so that would be my preface. Second part would be, I think we can come up with some kind. I worry about constituency-based directorships because it goes against exactly what we were just talking about, which is getting the right mix on a board. Even though you're absolutely right, once a director goes on a board, they have an undivided duty of loyalty to the corporation, not to whoever put them there. I think there are some interesting models. You know, Sweden, for instance, or sorry, France, for instance, has a model where voting rights increase with tenure of ownership. So if you've held shares for more than a certain number of years, your voting rights double, which gives long-term holders disproportionate ability to effectively nominate directors. Sweden has a system where large institutional owners get consulted in the board nomination process. The overlay, as I suggested, that I would put on that would be, if we're going to give those kinds of rights to shareholders, which we seem to be doing, and that seems to be where we're going in North America, we should also impose some responsibilities on them in the exercise of those powers. And then I've already answered the third part, which is I agree with you, that once somebody goes on the board, they have an undivided duty of loyalty. Of course, if you look at boards, that's not the way things often play out. And it's not just about shareholder nominees. People tend to be loyal to or feel some loyalty to whoever kind of put them wherever they are. And that's no less true of directors than it is of academics or CEOs. That's just human nature. So it's something we have to kind of deal with.
I just had a question related to tenure. It's clear that some dynamic change in the board is healthy, and most boards that I've been involved with have some form of limitation on that board. What are your any thoughts on dynamic change versus staying up for 25 years and
I think board renewal makes a lot of sense. I disagree with age limitations, absolutely, and I can tell you again, not to be personal, but if you looked at the BCE board, the most effective director on that board by far was Jimmy Pattison, who wouldn't have satisfied, and he's still on the board of Brookfield, which is one of the best managed companies in Canada, and a significant contributor. So it's got nothing to do with age, which I think Gordon Clark would agree with. But I think board rotation makes sense, and there should be sort of orderly succession processes within boards, just like boards are responsible for orderly succession within the management of the organization. How long a tenure? I don't know the answer to that, and all of this is intuitive. I don't have sort of any empirical research to back it up. It's just, people in any role lose their kind of edge or sense of purpose or vitality after a while, and just, so much of life is subjective. It's how we see things as opposed to how they actually are. And after a while, part of why I love teaching first-year corporate law every year or the basic corporate, is because once or twice during the course, some student who knows nothing about corporate law will ask a question that forces me to rethink my assumptions. And yes, that happens in practice when you end up before the Supreme Court of Canada about what the best interests of the corporation, but that happens once or twice in a career in practice. It happens with me every year with students. And it's that kind of getting new blood and new, somebody who's just prepared to ask questions which everybody else figures have been asked many times before, so there's no need to ask them again.
We have tried very much in this conference to stay on time, and it is 1 o'clock, which was the formal ending for this lunchtime session. And I know some people have to leave, so I do want to draw this part of the session to a close while indicating that the conversation is ongoing. So those of you who are part of the conference, or those of you who are visitors and would like to stay for the ongoing discussion, you're most welcome to do so, because we're going to continue this discussion. But for now, I want to thank Ed formally on behalf of all of us for his presentation, for reminding us that good governance and leadership are about engaging proactively with stakeholders, and for focusing on some of the paradoxes that exist, particularly the concept of trust, that as trust has diminished, more and more regulations have come in which have slowed processes down, which have made transactions much more costly, but at the same time have had the paradoxical effect of reducing trust. As someone who started their career as a geographer, I was particularly pleased to hear you reference the important contributions that geographers make. But I want to express our appreciation to Ed very much. And unlike the example that you used, I think you started well. You finished well with a very engaging question period, but there was an awful lot of meat in the middle. So Ed, thank you very much for your presentation. Much appreciated.